To read my disclaimer in full, please go to my website, elliottwaveplus.com. That's with two L's and two T's and no spaces. And scroll to the bottom of any page on the site. Click on the Terms of Service Disclaimer tab right there, and there it is. Please go there and read that in full. If I were to summarize it in one sentence, it would be, there's risk of loss in all trading. Okay, we'll move straight to the charts, and just a quick a couple of announcements here before we get started. I have a few new things to show you this week. I have developed a new weekly sentiment conditions template that I think can give some better longer term ideas of when the commercials are accumulating. And then I've also developed a alternate screenshot on the U.S. stock market on the S&P that I don't believe for a second is correct, but it's the super bullish version, something that I've noticed in chat rooms and different places like Seeking Alpha. There's an army apparently of super bullish trolls out there that if anybody ever suggests anything that is bearish, they're in there trashing him, and and it's quite prevalent today to for these to make fun of anybody who is suggesting that the market might possibly be able to go down. So for those people, I have put together a chart of what that would look like if we were in a super bullish count, and several other key factors that I talk about every week are being ignored completely, and just bullish all the way for some many weeks, months, and quarters to come. So I'll show that as well. So now we're moving to the U.S. stock market. We'll start, as always, with the Dow Jones Industrial Average. And I've gone over this many times. Let me just ask a quick question in the group. Is there anybody in the room that's new and doesn't understand how I developed these large degree Fibonacci targets, or is there anything about this long-term roadmap that you don't get? And if so, please chime in. I'll just give just a real quick idea. But there's these three Fibonacci targets up here, based on a price action since the 1932 low. One is the teal or cycle degree wave 5 target. It's a cycle degree wave 5, according to this count, has been underway since 1974. And it would be extremely extended fifth wave at 41,020. That hadn't been hit yet. And then up from the 1974 low, burgundy or primary degree wave 1s, 2, 3, and 4. We'd look for a fifth wave there that is normal. In other words, 0.618 times the net traveled at 1 through 3. That's at 41,981, basically 42,000. That hasn't been hit yet either. We would expect it to only be a normal fifth wave up because we already got a massively extended third wave, and usually in an impulse, in a 5-wave impulse, only one of the odd-numbered waves is extended. And in this case, we've already seen that in the third wave. Same exact thing here on the fifth wave up in burgundy. And so we're looking at a black 1, 2, 3, 4. Black is intermediate degree in Elliott Wave. Fifth wave up, best target 43,652. That's where black wave 5 would be a normal 0.618 times the net travel to 1 through 3. We've also already seen an extended third wave here, so we're looking for a normal fifth wave. So all of those, two of those targets are normal. one is massively extended for the fifth wave up from the 1974 low, and they're amazingly close together between 41,020 and 43,652, and that is what we call a Fibonacci cluster, target cluster. The amazing thing about that cluster, which is shown here with these targets here, here, and here, is that in the Dow Jones Industrial Average, those targets haven't been hit yet. But in the S&P, I developed the exact same three targets, and all three of those targets have now been struck in the S&P. So on balance, we are there. We're very close to the end uh, of 5 waves up from the 1932 low, the 1974 low, the 2009 low, and the 2020 low. So the wave 5 of 5 of 5 of 5, that's what those targets are about. So those have been very important to my work. It's been a bit surprising to see the S&P targets all hit now, but the Dow targets not. But let's face it, going back 100 years, there's been a rotation of the 30 stocks that are in the Dow Jones Industrial Average, and then there's been a constant rotation of stocks that are in the top 500 stocks as well. And so I guess we just have to figure that it's we're close. We're close to these targets, and really all we need is the finish of a 5 wave up structure from the March of 2020 low. Now there's a couple ways to figure that. In my estimation, because I am still respecting that target zone, I'm figuring that rocket ship move up from the March of 2020 low through January of 2022 was an ABC zigzag, and that's therefore wave one of an eventual ending contracting diagonal, where wave one is the longest of 1, 3, and 5. Wave 3 must be shorter than 1, and wave 5 in blue must be shorter than 3. Wave 4 must be shorter than 2 was. And but it must overlap into the price territory of wave 1. So my expectation is that we're going to move down here next in this wave 4 into the price territory of wave 1, and we'll do that most likely as a zigzag in according to the Frost and Prechter book. Each leg of an ending diagonal is typically a zigzag, a 5, 5, 3, 5 structure, an ABC structure, or something from the zigzag family, like a double zigzag or a triple zigzag. So in the Dow Jones Industrial Average, I think we got an ABC zigzag up from the March of 2020 low through this high in 2022. Now, what I'm going to show you in a minute on the S&P 500 is the wave count being all the same through here, but we'll just throw all those long-term Fibonacci targets just out. Who cares? Gone. And we're going to count this as a 5 wave up structure for wave 1, and this is a relatively shallow wave 2, and then we're going to expect that wave 3 would be a wave 3 of a non-overlapping standard 5 wave impulse. We're going and I've talked about this in previous webinars, but I haven't done a very good job of showing you what that chart would look like, and I've developed that chart for you so you can see. Then we're going to tear it apart and then see. We're going to find out, is there anything wrong with this chart? So that's coming up here in just a second. So I think we got an ABC zigzag for 1 of the diagonal, ABC zigzag for 2. Wave 2 was inordinately shallow. Usually in a diagonal, wave 2s are deeper. They're between a 66 and 81% retrace of wave 1. So that would have been substantially deeper. In this particular case, that was pretty shallow, just a 0.382 retrace. But now that we have new highs up here, um, it's most likely, in my opinion, that that was the end of the wave two, and now we got an ABC for the wave three, and we're expecting an ABC down for wave four. This ABC zigzag looks pretty good as a finished structure in March of this year on the Dow. And then we got an A and an ever so slight new all-time high for wave B. I'm considering that to be an aberration or something unusual that you wouldn't normally see in a perfect diagonal. Now, I got to tell you, in my experience, it's rare to see a perfect diagonal where each leg is a perfect ABC zigzag. The wave two is deep, and everything is just perfect. It's an odd structure. It's an unusual structure, and many times there's something here or there about it that does not conform to the stringent rules put forward by the Frost and Pareto. Anyway, this is what if up from the March of 2020 low. This initial wave up was wave one, a 5-wave structure, and then we got a wave two, and now we would get a normal wave three. And so, in order for this to work, we'd have to ignore all of the long-term targets going back 100 years. And we would only be working with Fibonacci targets starting at the March of 2020 low. So if this was a wave one of a non-overlapping 5-wave impulse, and this is wave two, then the best target for the wave three would be 12,500. 12,500. That would be where wave three in blue would be equal to wave one in blue times 1.618. I consider that to be a minimal target for a normal wave three in the stock market. That's right, 12,489, so 12,500. And so if that was the case, and that was the target for end of the wave three, then we would have to start the wave count with some very bullish 1-2-1-2s down here, starting at the October of 2022 low. So 1, 2. In pink, 1, 2 in green, 1, 2 in orange. And so I've set the Fibonacci targets for that would be most likely in up for the wave three, up from each of one of those sets of 1, 2 here. So this would be the target. 6,000 would be the target for the end of the orange wave three. So if this is orange 1 and 2, and we're in orange wave three, it hit there. 6,750 would be the target for the end of green wave three. 1, 2, 3. In that case, the green wave three would be 2.618 times 1. And then the green pink wave three would need to be a 4.236 times the length of its wave one in order to continue this progression as we move through 3, 4, 3, 4s. And so every time I see some permeable troll making fun of anybody that's getting worried about this stock market right now, then I think that they ought to take a look at this chart and see if this is what they see if they can believe that this would occur. So now that I've shown you this 12,500 target, and by the way, that would be the end of the third wave up from the March of 2020 low. Then you'd have a 4 and a 5 after that. So the question is, what's wrong with, what are some problems with this chart? And I've shown several of them here. One, the count is not supported by cycle analysis in any way. So we just have to eliminate the problem number two. Here's a trend line extending from the 2000 and 2022 highs. And we're at that resistance trend line right now. So this wave count would require a profound bubble of magnificent proportions and a breakout above a line connecting the 2000 highs and the 2020 across the 2022 highs right here. I've been talking about how this really does not look like a proper five-wave structure to the upside on the S&P, and there's some big problems with that. And the problems occur in the area of Fibonacci relationships between these waves. Now, there's a lot of people that counted that as a five-wave structure up, but they like Prechter, and he figured that's as high as the stock market will ever go. Well, that's not the case, obviously, now. But the problems came in the form of Fibonacci relationships. So if wave three, if this is the one and two, if wave three was going to be a normal 1.618 times wave one, it would needed to go all the way up to where we're at now, 5,500. And so wave three was actually short. It doesn't look like it here, but it was actually short. Another problem is that the wave five was much shorter than a normal fifth wave. And waves two and four were virtually identical. So they did not fulfill the guideline of alternation, where they're both shallow and brief, about the same size, and that they did not fulfill the guideline of alternation. So here to me is the biggest problem with this count is that the high target using those long-term Fibonacci's, and the best target for the end of the fifth wave up in black from the March of 2020 low is at 5405. That's what I've been showing on my charts for a very long time, and that's essentially about where we're at on this chart now. So that's the best target for a normal end of a black wave 5 up from the March of 2009 low. And we've already seen an extended third wave there. So that would be a normal fifth wave. It'd be very rare to get an extended fifth wave after we've already seen an extended third wave in black. Additional problems with count. In order for the S&P to reach up here into the 6,000s, like this target, this green target right here, that would require that the growth, the GDP growth that we've been seeing lately, stay in a straight line just like it has been. And it would require P to E, price to equity, expansion all the way up to over 30 P to E ratio. So that would be profoundly stretched historical valuations, and really we're already there. The P to E ratio, I believe we're currently at around 37. I'm sorry, 27. I'm going to look this up. Ratios. So right now, the Dow Jones Industrial Average is at a 27 PDE, and the Russell's at 27. The S&P is at 24. Nasdaq's at 31. So these are already profoundly rich valuations historically. Way above average evaluations and near the peak of valuations that we've seen at some historic tops. And so, but this would, if this count was correct, it would require continued P/E expansion and continued growth at current rate. So the additional problems with this count, not only does it not respect the wave 5 target in black, it doesn't respect the other Fibonacci, long-term Fibonacci targets up from the 1932 and 1974 lows. Another problem. Current sentiment conditions here in June of 2024 are at levels associated with significant stock market tops in the past. Already talked about the P/E expansion that would be required. And the market has been extremely narrow lately. We've talked about that, where NVIDIA was about the only stock that was keeping this S&P moving higher. And the fact is that since from this low up through May of 2024, there's been zero earnings growth in the bottom 493 stocks in the S&P 500. So it's an extremely narrow market now. But if this wave count was correct, we would be at the point of recognition, wave 3 of 3 now. So we would need a gap up and it would never fill that gap, and it would just keep going up. So these hecklers that are permanently bullish and make fun of anyone who would even suggest anything bearish at this point are ignoring a lot of problems with just willy-nilly just figuring, hey, it's going up, it's going to keep going up. So I hope you like that new chart. I think it exemplifies exactly how difficult it would be at this juncture for the market to continue to rip higher. This is the first weekly sentiment conditions chart that I'm going to show you, and I've added these in a number of items: the ES contract, the NQ, Nasdaq, gold, bonds, and the U.S. dollar and euro. And so I've added a few of these. If you can see what commercials, clearly see what commercials are doing over a little bit longer period. So on my daily sentiment conditions screenshots that I show, these are daily candles, and it's a little harder to view what they're doing over a long period. So what I did is I took that same template and I put it on a weekly chart, and I'm only including the 1 year or 12-month look back indicator here. And then I'm adding the DSI indicator where the retail traders currently are, and then a 3-period moving average of that. And then I'm also including the money flow index, which I think shows on a weekly chart some pretty amazing I wouldn't call them signals, but situations that suggest that the market's extremely stretched, and is in trouble, just like it is right this second on this weekly chart. So the money flow versus RSI, we're getting that dark red stripe. The money flow has dropped below the RSI, while the RSI is above 70 on a weekly chart. That doesn't happen very often. The last time it happened was here. And that was in November of 2021. And as you may recall, that was the actual high on like the NASDAQ, whereas the S&P and Dow managed to barely scrape out a new high going into the new year of 2022 at that time. But that was a warning. There was a big warning going into the COVID crash. So we're getting that. Retail is currently extremely bullish. Recently, the recent high right here on that indicator is on this weekly chart. These are weekly closes then. It was an 87. And when that happens at the same time as you see commercials heavily short, that's a warning. So this is a warning. And when the ADX indicator is over 60 on a weekly chart, you don't get very many of these tan uh, zones, but that's also a warning of deeply overbought or deeply oversold. So when I do show this weekly sentiment conditions, it actually pinpoints some pretty interesting. I'm going to go ahead and call them signals. Like here was a buy signal that came in here where the commercials very quickly got heavily long, very, very quickly after the retail traders were heavily short. There was essentially a buy signal. And then commercials started hedging here. At the same time as retail stayed very, very bullish. And it wasn't until about right here that we had commercials still heavily short, retail heavily long. That kind of it did exist for a period of time, but finally gave its final signal here for a move down. And then this really was a perfect long setup. This was in October of 2022. Commercials had been accumulating ever since back here. They were accumulating long positions at the same time as retail was dropping down. And we even had retail give a green zone. And that was followed by the first green candle. Remember the candle color on this is only it changes color with the slope of the 3-period moving average of the DSI, the daily sentiment index. So that gave him a beautiful buy signal here. Here's the really interesting thing about this chart, and it's that the market got extremely overdone here. Commercials were heavily short, retail heavily long. It was a perfect short setup. That occurred in early August of 2023, and we got some downward movement. But look here at the lack of a signal in October of 2023. Commercials were still heavily short. Now, retail got short enough. Retail got down to a 10. So that wasn't really a perfect setup. And the commercials generally haven't really strongly believed in this last move to the upside. They're scared. They're waffling between fully hedged and nearly fully hedged during this entire move up from October of 2023. Retail has certainly chased it. 20. So I've been saying that there's some things wrong with this rise and how it's continued to the upside. And this once again kind of shows that if this was the greatest buying opportunity of all time, and the funny thing is on a daily chart, I was suggesting that we were going to get a move up from that low through the end of the year at that time. But it turned in to be a much stronger move. But there's nothing about this chart that suggests that it should have been this strong. Something going on here. I guess it's for a lot of that, you can blame on the NVIDIA, I guess, situation and how profoundly narrow the market was. And it got down to the point where only one stock or two or three were pushing this thing higher. But it really shows how unusual this rally has been this year.